You may be pleased to know we have a pretty quiet week for macroeconomic news ahead of us. The two main features, barring the ongoing Brexit situation, will be the latest policy decision from the European Central Bank on Wednesday the 10th of April, and then the spring meeting of the International Monetary Fund, or IMF, and that will run from the 12th to the 14th in Washington DC. So far as the ECB is concerned, it has already backtracked on any plans to tighten monetary policy this year. President Signor Mario Draghi put interest rates on hold for 2019 at the last meeting, and also announced the offer of fresh cheap credit for banks so they in turn can lend more, so the theory goes. The so-called Targeted Long-Term Refinancing Operations, or TLTRO, well, that starts again in September. It's hard to imagine Signor Draghi being any more dovish than he's been already, although the US Federal Reserve managed to surprise everyone with its much softer policy line at its March meeting, so you never can tell. This first graphic shows the headline ECB interest rate and its balance sheet, and the balance sheet shows how much quantitative easing it's done, and that's going back to the start of 2009. As for the IMF, most interest will focus on any revisions to its global GDP growth forecasts in its half-year update to the always interesting World Economic Outlook document. You can download both the half-year update and the full-year version for free from its website. Just to remind you, the IMF's key forecast for 2019 last autumn was global GDP growth of 3.7%. That's the same rate as 2018, and that forecast is based upon 6.2% growth in China, 2.5% in the US, 1.9% in Germany, 1.5% in the UK, and 0.9% in Japan, to look at just 5 major economies. In this chart, by the way, the bar on the left is 2018 and the bar on the right, the IMF's current forecast for 2019. It will be interesting to see if the IMF reflects financial markets, and for that matter central banks' latest bout of jitters about the global economy and growth. Company-wise, well, scheduled news announcements are also a little bit thinner on the ground, although it's going to be a busy week for retailers. Interim or full-year results releases or trading updates which may be worthy of note include the following. Silver miner and FTSE 100 member Fresnillo on Wednesday the 10th, when retailers Dunelm and ASOS and recruitment firm Page Group will also publish numbers. 2 more retailers in the form of WH Smith and Mothercare on the 11th of April. And then to finish things off, yes, you guessed it, another retailer, this time in the form of Moss Bros, and that will be on Friday the 12th. But the company which could really cause the biggest fuss in the week ahead just might be supermarket giant Tesco. It's due to release its full year results for the year to the end of February on Wednesday the 10th of April. As we can see here, Tesco's shares lost ground along with the broader UK stock market in the second half of last year, but they've rallied strongly so far in 2019. Last year, Tesco's operational performance was dogged by weak trading in Asia, especially Thailand, and also Central Europe, while the launch of its discount chain Jack's raised some concerns that the new venture would cannibalise sales at the core brand, even as the firm took the fight back to discounters such as Aldi and Lidl. At least the third quarter Christmas results were solid enough, as Tesco unveiled strong trading at wholesaler Booker, acquired for around £3.7 billion in cash and stock last March, and it also uncorked its 12th straight increase in like-for-like sales in the UK. So, when it comes to the full year results, analysts will first turn to the fourth quarter trends in like-for-like sales. Remember that in Q3, the UK grew by 0.7% and Booker by 11%, to give a group-wide increase of half of 1%, even if sales fell in Central Europe and Asia. Signs of improvement in Asia, where Tesco has launched a turnaround programme, and ongoing progress in the UK and at Booker would no doubt be welcomed by shareholders. For the record, the actual forecast for the stated sales figure is £64.1 billion against £57.5 billion in 2017. Now next up, analysts and investors will head to the pre-tax profit figure. Here the consensus forecast is for £1.8 billion against £1.3 billion a year ago, although last year's number was actually boosted by a net £155 million in positive exceptional items. They're related mainly to the sale of assets and property, so the underlying base for comparison is nearer to £1.1 billion. The third and final headline figure to note will be the dividend. Chief Executive Dave Lewis and the board sanctioned a 67% increase in the first half payment, and for the full year, analysts are looking for a distribution of 5 pence a share, compared to 3 pence last year. We can see the trend over the last decade here, and Mr. Lewis will be looking to banish the memories of 2015 to 2017, when Tesco either cut its dividend or indeed made no payment at all. Finally, investors will be looking to Mr. Lewis for an update on the core strategic goals that he first outlined back in October 2016. Remember that before the Booker deal, Mr. Lewis was targeting a 3.5% to 4% operating margin for 2019-20, up from 2.3% in 2016-17. And when the Booker deal was first announced in January last year, Tesco targeted £200 million of annual cost benefits on an annual run rate basis within 3 years, and a further £25 million in revenue benefits. So we shall see. Thank you for watching, and I look forward to seeing you next time.